Mentors and role models. Steve had Art Rock, who was the dean of venture capital. He really invented venture capital in Silicon Valley in the late 1960s. He came out from New York and funded Intel ultimately, SDS and a couple of other companies before that, but Intel was the big hit. And Mike Markkula, who was the first CEO of the company and first adult supervision, as they like to say at Apple. Larry Ellison had Don Lucas, who was a founder, was an investment banker before, but one of the early investors in National Semiconductor. Scott Cook had John Doerr and Burt McMurty, and my favorite story about this, that they're both venture capitalists, is that after Quicken finally got traction and was making sales and even a profit, only then did Scott Cook and Tom Proulx go out for venture capital. And by then the company was worth a lot of money and they didn't really need venture capital. What they needed to do was pay off the debts that they'd incurred to finance the company. So when they raised venture capital, they were selling their own stock, not company stock, but stock out of their own pockets. And they collected term sheets from 5 different venture capital funds. And Scott called me up and said, I'd like your advice on which of these venture funds to go with. To avoid biasing you, I'm going to tell you the valuations, I'm going to tell you the funds, but I'm not going to tell you which ones are which. And so the valuations ranged from roughly $50 million to roughly $75 million, which is a lot when you're selling stock. It's the difference between $1 per share in your pocket and $1.50 per share in your pocket, 50% more money. First thing I did is I connected the dots and told him my guess as to which venture funds had offered which valuations. And he said, how did you know that? And I said, I've dealt with these folks and I know which ones are value investors and which ones maybe are trying to buy into what looks like a good deal here. Well, what's your advice, he asked. And I said, take the 2 lowest valuations you were offered. And he looked at me and said, you must be kidding. Why? It's 50 cents less in my pocket per share. And I said, because those 2 offers come from John Doerr and Burt McMurty, who were in my judgment, 2 of the very best venture capitalists in the business, and this is in the early 90s, before John Doerr was as well known as he is today. But he was certainly an extremely bright, capable, and successful venture investor at the time. And Burt McMurty was one of the patriarchs of venture capital, like Art Rock, one of the early venture capitalists in the area, and I'd worked with both of them. And I said, these 2 fellows are going to make more difference in the value of your company than the difference in valuation now, that someday this company will be worth a lot more money and it'll be because of them. And Scott has kindly acknowledged that that's true, and he recognizes that that's true, although he didn't take my word for it. He did something quite remarkable. He asked them both for 10 references so he could do some customer checking the way he had been taught at Procter & Gamble. And he asked them both to write a 10,000-word essay on how they would deal with encroachment if Microsoft tried to compete with Intuit. And John, I think, wrote the essay. I don't think Burt ever wrote the essay, but John's version of the essay still exists. And a couple of years ago, when Burt retired from the board, retired from venture capital, they read the essay at the retirement dinner. And so Burt was on the board for 10 years plus, and John Doerr is still on the board going on 14 years, even though their venture funds have long since distributed. So they have no real economic interest and no professional reason to be on the board other than they like the company and they stayed with it. So very unusual behavior for venture capitalists to stay on the board for so long. But now the company is worth many billions of dollars, and Scott did very well with the advice. And then, of course, I think you had Bill Campbell speak probably last quarter, and he's done this, I think, every year, and he's with Mike McHugh of Tell Me, I think. But I would say dozens, literally dozens of entrepreneurs in the Valley have been coached by Bill Campbell. And he's a mentor simultaneously to about half a dozen companies that I represent today, and he's just a phenomenal catalyst in Silicon Valley. And then, of course, there has to be a touch of capital to make it all work. And fortunately for Stanford, you're kind of at the bottom of Sand Hill Road, and all the money is just flowing downhill to Stanford. And I don't know why, I do know why, actually, a real estate developer named Tom Ford decided to build Sand Hill Road as the seat of venture capital. He made it very easy for venture capitalists to locate there. And of course, the proximity to Stanford is a big deal. There's always been this history of Fred Terman and Hewlett and Packard and the very end, the very mutually beneficial cooperation between Stanford and the entrepreneurial community has always been part of it. And venture capital, the Arthur Rocks and Burt McMurtry's of the world, located here. Now, something like 60% of the world's venture capital is managed up at 3000 Sand Hill Road, a few miles from here. And you'll see venture capitalists at gatherings like this, crawling around looking for ideas. And Jim Gibbons, who I mentioned before, used to organize something called the Sunrise Breakfast Forum. I don't think you do that anymore here, but it was a early morning. It was a typical gym. It was a 7:30 in the morning session where a faculty member, a grad student, and somebody from industry would talk about the newest technology in disk drive readers or something. And students and venture capitalists were invited, but no lawyers. I was allowed to come because of my prior credentials as an engineer. Jim would let me come. It was a very, very rich environment for networking, and you'd see companies getting funded from these exchanges of ideas. And venture capital is readily available in the Stanford environments, fortunately. As you know, the way Silicon Valley companies are organized is stock options for all, very democratically doled out on the theory that owners work harder and have an additional incentive to build a company. It seems to work marvelously. Certainly, all the companies that were on that slide I showed you before benefited greatly from doling out stock options as broadly as possible. Now, as you know, it's threatened by some accounting charges that would make stock options appear as an expense on income statements, and people are wondering whether we'll still be able to dole out stock options with the same degree of democracy across a company when those accounting charges hit. That'll be beginning in 2005, so that's something that's got the world a little bit shook up. And then, of course, liquidity, the dream for IPO, although most entrepreneurial companies achieve liquidity through an acquisition rather than an IPO, probably 80 to 90% are required rather than go public. Now let's talk about one that is going public. Google, the dictionary word, means a very large number, 10 to the 100th power. And the company that adopted an eponymous name there has set about solving a very, very big problem. We all of course, use Google, and it's ubiquitous. Talk about drive. The story is wonderful about this company. The technology was developed here at Stanford by some graduate students, the search technology, algorithmic search, and they tried hard with the Office of Technology Licensing to license the technology outside the university and couldn't find anybody to take it. So they gave up and decided to start a company to exploit the technology. Stanford has an equity stake. I think Stanford has royalties. They're off and running. They have great mentors. Eric Schmidt, a CEO who was the CEO of Novell and other, very active in other companies in the Valley. John Doerr, again. Mike Moritz from Sequoia Capital. Ram Shriram, who was a successful entrepreneur before, sold his company, I think it was to Microsoft. Bill Campbell, I mentioned, and our own John Hennessy are all advisors and members of the board, or at least unofficial advisors. I don't think Bill Campbell is a member of the board, but they're being very, very helpful with Google. And of course, Google couldn't have been started without venture capital from Kleiner Perkins and Sequoia Capital and Ram. And Andy Bechtolsheim, who gave him the first seed investment here on the Stanford campus, wrote a $100,000 check, no questions asked, no business plan, no nothing, because he was, I think you all know, was the founder of Granite, which he sold to Cisco for $100 million back in the early 90s, and was a very, very successful serial entrepreneur. And now, what will be the biggest IPO by Silicon Valley standards? There are bigger IPOs in financial industries and so on, but the $2.7 billion IPO is a couple of orders of magnitude bigger than a normal IPO.